My name is Jay Shambaugh. I'm the director of the Institute for International Economic Policy, or IIEP, here at GW, and I'd like to welcome you virtually to Washington, D.C. We at IIEP are very pleased to be hosting this event on the October IMF World Economic Outlook. We at IIEP have been partnering with the IMF for over 6 years, I believe, at this point, helping to roll out different major publications. And of course, for the IMF, the WEO really is the flagship publication, drawing considerable attention around the world and in policy circles. The IMF obviously does its own rollout. The idea of these meetings is to be able to provide the opportunity for the authors to do a more detailed presentation of the work and to have a robust conversation with an outside discussant. IIEP is located at the Elliott School at GW, and we aim to serve as a catalyst for high-quality, multidisciplinary, and nonpartisan research on policy issues surrounding economic globalization. We interpret that mandate rather broadly and include work around trade, to international finance, to international development, poverty studies, climate change, and economic policy more broadly. We've been very busy at IIEP lately with ongoing series on India's economy, China's economy, inequality, rethinking capitalism, multidimensional poverty, and rebooting trade policy. Please visit our webpage to see upcoming events and to find links to past events. Today, I'm really excited to see the presentations. There's some terrific work that the IMF put out in this semi-annual World Economic Outlook. And so we'll have 3 different presentations with the 2 analytical chapters followed by an academic discussant. And I'll introduce each of them as we get to them. So first up is John Bluedorn, who's the Deputy Division Chief on the World Economic Outlook team at the IMF's Research Department. And he'll be presenting the first chapter, The Global Prospects and Policies. It's a special pleasure for me to introduce John, as I have known him since we were working together on problem sets in our first year of graduate school. So John, please, the floor is yours.
Great. Thank you very much, Jay. Really pleased to be here. I see you and present at this event that GW and the IIEP is sponsoring. So let me go ahead and get started. And I'll share my screen. Hopefully, can you all see? Great. So thanks very much. So I'm going to present an overview on the key themes and policy messages in what we refer to as the conjunctural chapter for the October World Economic Outlook. And this is going to highlight some of the changes that we see in both the context and the projections since our July 2021 WEO update. And the WEO draws upon the work of a team in research, but also inputs from country teams and colleagues across the entire IMF. And it's really a product of the fund as a whole. So broadly, we see 4 key themes. So 1, the fault lines in performance across economy groups that we have identified in earlier World Economic Outlook seems likely to extend into the medium term. And this is driven largely by inequities in vaccine distribution and policy shifts that have led to that will lead to near-term divergences to become medium-term scarring. A second theme is that the employment recovery is lagging the output recovery in many countries. Third, there's increased uncertainty about the pandemic path, with the rapid spread of the Delta variant over the summer raising doubts about how quickly the pandemic can be overcome. Fourth, policy choices are becoming more difficult. Rising inflation and more constrained policy space are making policy choices more difficult despite the recovery being incomplete. And we are really in uncharted territory, with the recovery in the midst of a pandemic and policy space seeming stretched in many countries. Moreover, the risks have become more heavily tilted, I should say, to the downside. In particular, I'd highlight a couple of the big ones. 1, the emergence of more and detrimental SARS-CoV-2 variants is a real possibility. Second, if the supply-demand mismatches that we're seeing now could become more persistent, that potentially raises the risks of persistent inflation and surprise monetary tightening, which could make for tougher global financial conditions. From a multilateral perspective, the key policy objectives in this environment are really getting the vaccinations equitably distributed worldwide and getting the pandemic under control globally. Second, climate policies. Climate change is a key priority, and getting some tangible actions on that front are really important. Third would be ensuring that there's sufficient international liquidity for countries as they try to navigate this recovery, particularly for those where policy space may be more limited. For national policymakers, the aim is really to achieve maximum sustainable employment while protecting the credibility of their policy frameworks. And this means that the policy mix has to be tailored to country-specific pandemic and economic conditions, including policy space. So to highlight a couple of key aspects of this conjuncture, two are that the vaccine distribution around the world and the supply-demand mismatches. So the pandemic entered its fourth wave over the summer with confirmed deaths from COVID rising. However, this wave has been different than earlier waves in that there are now a chunk of countries that have significant levels of vaccination against COVID, which is providing protection to those populations against the most adverse outcomes, like hospitalizations and deaths. Stark inequities in access to vaccines, that's seen in the left panel here, is an important determinant of pandemic and hence economic dynamics now. In parallel, inflation pressures have built up with ongoing supply-demand mismatches due largely to supply bottlenecks. In the right panel, you can see this recent rise in supply disruptions with PMI indices for supply delivery times, shown in deviation from a historical estimate based on manufacturing output PMIs. This is also reflected in the sharp increase in shipping costs, shown here with the Shanghai Containerized Cargo Index, which is a measure of finished and intermediate goods shipping costs. Turning to the outlook, the main message is that the recovery is expected to continue with the path for global activity broadly unchanged, but with differences across and within countries. So as you can see in the leftmost column here, the world economy, we have a very small downgrade expected for 2021 to 5.9% for the year growth, and for 2022 unchanged from what we had in July, which is 4.9%. In the case of advanced economies, growth prospects for 2021 have been revised down compared to the July forecast, and this largely reflects downgrades to the US, which is largely showing due to inventory drawdowns in the second quarter, partly reflecting supply disruptions and some softening consumption in the third quarter. That's offset in part by upgrades for the euro area as a whole, these two are shown in the far right columns as they have some of the larger revisions that amongst countries. Otherwise, I am exhibiting here some of the economy groups. In the case of emerging market and developing economies, the forecast for the group is marked up slightly compared to the July 2021 update, with improved assessments for some commodity exporters, for example, Russia and Saudi Arabia, outweighing drags from pandemic developments across most regions. Perhaps most concerning, the growth forecast for the low-income developing economy group has been marked down by 0.9 percentage points relative to July. And that's largely due to the continuing slow rollout of vaccines as the main factor weighing on activity there. Turning to medium-term prospects, we expect there to be scarring, defined as performing worse than the pre-pandemic expected trend in both output and employment for the world as a whole. But this is concentrated in emerging market and developing economies. And you can see that in the leftmost panel with the large gap between the dashed and solid red lines. Although the broad picture has not changed much, there have been revisions and projections across countries. Now, when we look at these latest revisions in our output projections, we can see that differences across countries in vaccination rates are an important driver. That's shown in the lower right panel here, with countries where vaccination coverage went up compared to March 2021, seeing upgrades to their performance across forecast horizons. This is another sign of how important the pandemic and vulnerability to the pandemic are to the economic recovery. That was the picture for real output, but another key variable of interest is inflation. Despite recent price pressures, the baseline outlook for inflation is fairly benign, with inflation expected to decline in the next few quarters. Price pressures decreased noticeably in 2022, in other words, reflecting the expected abatement of many of the supply bottlenecks by mid next year. The decline in inflation in some emerging markets, for example, Brazil and Russia, is also supported by significant monetary tightening. Policy rates are also anticipated to pick up towards more usual levels seen in recent history. That's in the rightmost panel here. But these projections are subject to significant risks. Uncertainty has gone up in recent months. On the upside, the recovery could be stronger than expected if vaccine production and distribution are faster than we're assuming, if productivity growth ramps up from changes in production and distribution and payment systems that have been occurring. It could also be that if the structural investment plans that are expected, in particular in the US or in Europe, ended up being deployed faster and were more effective. That said, the downside risks are dominant. Things could turn out worse than expected, in particular if there's this emergence of more transmissible and deadlier SARS-CoV-2 variants. I flagged also the potential for more persistent supply-demand mismatches lasting beyond, say, mid-2022. Another would be if the US fiscal package turns out markedly smaller in terms of its overall impulse, spending net of any revenue-raising measures. That could lead to some downgrade in the growth projections. Another could be financial market volatility from failing to raise, say, the US federal debt ceiling. So there's been a little reprieve given here, but that still remains to be done later this year. Or if there are large-scale disorderly corporate debt defaults and restructuring in China's property sector with recent issues there. Another could be any intensifying unrest, geopolitical tensions ramping up, trade policy uncertainty, cyber attacks. And finally, I'd flag the potential for even more adverse climate shocks, which we saw a lot of this past year. So what can policymakers do to strengthen the recovery, making it more resilient to some of the risks described, and at the same time address post-pandemic and structural challenges? The first and by far the most important is what we all know: reduce vaccine inequities. Vaccines save lives and boost economic activity. And here's just a couple of illustrations of that point. One is the case of the UK, comparing what happened this past summer versus what happened back in December 2020. So back in December 2020, there was no protections really from vaccinations. And you can see deaths and hospitalization totals really went up a lot as infections did. By contrast, in the summer of this past year, there was a much wider spread share of vaccinations, with 70% of the adult population being vaccinated. And in July, even though cases went up, hospitalizations and deaths stayed comparatively low, much lower than they were, say, back in December of 2020. Second, I'd flag that recent research by fund colleagues suggests that not only vaccines controlling the pandemic, but they can also be powerful drivers of economic recovery. In that work, they found that US counties which vaccinated more saw higher increases in consumer spending and lower levels of employment than in counties that lagged in vaccinations. So beyond measures to bring the pandemic under control, other multilateral policy priorities include investment in climate actions and raising productivity, addressing the labor market's lagging recovery, and also trying to remedy the learning losses we've seen from school closures. I'm not going to go into great depth in some of the details here, just given time constraints. Also easing financial constraints to struggling countries. So we've seen, the SDR allocation, which has been important. Tackling debt vulnerabilities, that's going to be, we'd really like to see some improvement in the common framework endorsed by the G20 that provides this mechanism for timely and orderly debt restructurings. Also diffusing, that should be defusing, trade and technology tensions. Some of these predate the pandemic, and so advice on that is to work within the rules-based trading system to diffuse those. And finally, to complete agreement on the global minimum corporate tax. Finally, turning to national policy priorities, these have to be adjusted to country-specific pandemic and economic conditions, recognizing the more binding policy constraints that many countries are operating under. On the fiscal and structural front, the key policies include continuing the health spending as necessary, vaccines, testing, and treatment to address the pandemic, Second would be facilitating growth opportunities related to green technology and digitalization, as well as reversing the setback to human capital accumulation that we've seen and reducing inequality, which has also been a consequence, a rise in that from the pandemic. And finally, reducing sovereign debt overhangs through restructuring measures and the like. Whoops. On the monetary policy front, it would be that central banks can generally look through transitory inflation pressures, but should stand ready to act if the risks of inflation expectations de-anchoring rise sharply. Where there's a tangible risk of that, they may need to tighten to get ahead of price pressures. Where the recovery is strong and vaccinations widespread, it's important to have clear and transparent communications about when monetary normalization may be coming. And finally, on financial policies, any measures that help to support credit and stabilize balance sheets should become more targeted to help avoiding the creation of zombie businesses that are ultimately unviable. Related to that would be the priority of strengthening insolvency frameworks to expedite the resolution of debt overhangs. And I'll conclude there. Thanks.
Thanks so much, John. I know we don't have a discussant for this chapter because we wanted to leave more time for the two analytical chapters, but I did want to just ask one or two very quick questions to you. Given the extent that you I think put a lot of weight on the importance of expanding vaccine availability, especially to the low-income countries, and you talked about kind of the fund plan and what the fund thinks should be done here. I was just curious if either in the chapter or in the fund's view, there's kind of an optimism or pessimism as to whether these things actually will take place. And so, it feels like every week or so you see an advanced economy government making an announcement, we're going to donate this many vaccines, or we're going to donate this many. And do they add up to enough? Are the commitments sufficient? And is the question on follow through, or is there real need, just more needs to be even committed?
I think it's really both. There's a need for follow through on the pledges, the donation pledges, say, for vaccines. Those actually need to be delivered. At the same time, there also needs to be some ramp up we need more production. Some of that needs to be kind of regionally diversified, but both of these things need to happen. Essentially, we need increased production, as well as some more kind of reallocation, reprioritization of vaccines to these areas of the globe that have lagged behind in terms of that, as well as then following through on the pledges that have been made. There's been some progress there, but I don't have a sense yet, a full sense of whether that's going to be sufficient.
Thanks. The other thing that you put a bunch of weight on here, and I think making sense, is on the supply-demand mismatches and supply chain disruptions. And it seems in many ways like the fund is uniquely well placed to speak on these because they are global issues. And any one country can think about what's going on in their own economy. The question is what's happening everywhere else as well. And I guess I'm just curious if there's much of a view. In the US, you can see kind of two stories, right? One is like lumber prices shoot up, more sawmills open up, lumber prices go back down, and economists sit there and say, yeah, price signals can work. And then on the other hand, you can see car prices shoot up and auto manufacturers can't expand because they don't have enough semiconductor chips, and say, well, it takes a really long time to build a new factory to make more of those. And is there much of a sense at the fund where which type of disruptions we're looking at more broadly? Like, are more of these things where, hey, we can fix this, we can make more containers, or we can open more sawmills? Or is it really, no, it's going to take $2 billion in 2 years to build a chip fabricator, and like you're not getting more of these soon, and so the supply chains are going to be tight for a long time?
I think you raise a good couple of points on what I think of as basically there's sometimes really large adjustment costs that have to be paid in terms of investment. I think we do know in chatting with various kind of market participants, I guess, or producers, basically, that there has been, as you mentioned, some supply response. And so there's plans, for, say, in the case of shipping, increasing kind of the number of containers that are being produced and the like. And so that will take some time, but that will start to come online, say, over the coming quarters, and that will help kind of provide some offset. For things like that you mentioned, like these, big factories and the like, that is a much more longer kind of term, as you rightly noted, investment. And so that may well take some more time. I guess another thing I would mention is that part of what the supply kind of bottlenecks we're seeing is actually related to the pandemic itself. And so as the pandemic becomes under control, which is a much more kind of nearer term potential over the next quarters, that alone will also help potentially alleviate some of that. We've seen, for example, in China, there's been some port shutdowns actually as a result of trying to control outbreaks. We also see that there are worker shortages in some, say, ports that, and some of that's related to health concerns that, say, workers still have, or they're struggling with things like, in the case of many mothers, childcare access and the like, that still present, that means that there's not necessarily the staff on hand to be able to kind of help fuel that supply. Yeah.
Terrific. Thanks a lot. And I should just note to our audience that there is a Q&A tab that you can put questions in that I can then bring back to our authors as we go. And so I think we'll probably come back to John with questions as well at the very end when we're kind of wrapping things up. So thanks very much for that presentation. What we're going to do now is turn to talk about something we were kind of talking about around the margins when we were talking about the supply chain disruptions, which is thinking about inflation and inflation scares, which is a very appropriate thing as we head into Halloween to be frightened about. So we have Christoffer Koch is a presenter. He's an economist in the research department of the IMF, and he'll be followed by Tara Sinclair, a professor of economics at George Washington, with a discussion. So Christoffer, turn it over to you.
Yeah, thanks very much. So like much of the stuff that is being done at the fund, this is really a team effort together with Francesca Caselli, Sonali Das, Prachi Mishra, and Philip Ingenda, and help from Shunya Wu from Rochester, and Yu Wan and Cynthia. So we'll be talking about inflation scares and inflation in particular. So what people have seen is that over the past 2 years during the pandemic, especially in advanced and emerging economies, inflation has been rising sharply. This graph shows inflation developments over the past 2 years with 5 different measures for the typical country groupings that we have in the IMF: advanced economies, AEs, emerging economies, EMs, and we show core measures and headline CPI measures. And what you see is really a lift off of inflation over the past year or so. And that poses severe questions for policymakers as to how to interpret that, what to do about that. The recent drivers of this are excess savings. We have seen a lot of monetary accommodation and fiscal accommodation from the policy front, as well as rises in commodity prices that you see in the middle chart. Here we plot oil, food, gas, and metals, as well as these supply chain disruptions that you've already seen in John Bluedorn's presentations. And just to give a bit of context of what John mentioned earlier, think about one of the busiest trade routes that we see in the world, which is mining ore products from Australia to China, which typically took like about 10 days, but now with these quarantine requirements of 2 weeks, it takes 14 days. That in bulk shipping is an increase of like 40% of shipping time on one of the most busy trade routes in the world. So these supply chain disruptions continue to put upward pressure on prices. Now, this chapter's goal really is to examine like 3 things in particular. It wants to look at how much does the classical demand-driven Phillips curve / inflation relationship contribute to inflation dynamics going forward. It also wants to look at, we want to examine the evolution of inflation expectations during the pandemic and assess potential risks of de-anchoring during the recovery phase. And third, the COVID-19 pandemic and related policy and private responses, such as work from home and social distancing, led to peculiar sectoral dynamics that are different from potentially other recessions. We thus want to study sectoral and commodity price movements and their impact on headline inflation. So what we want to do is we want to forecast inflation, assess the balance of risks, and think about inflation expectations for the short and medium term. And just upfront to tell you what we find, Headline inflation is projected to peak in the fall of this year, in 2021, with inflation being back to pre-pandemic levels by mid-2022. That's our model forecast for both advanced economies and emerging economies, but risks are somewhat tilted to the upside. The recovering demand is expected to have only a mild impact on future inflation, and inflation expectations are remaining relatively anchored, and the risk of de-anchoring appears limited. Sectoral price dynamics suggest moderate risk to the outlook, but there are some extreme scenarios that I'm going to walk you through. These tail scenarios are something that I think people should potentially keep on the back of their mind, even though the model outlook is very benign. Okay. So these are the three parts that I mentioned earlier. Let's begin to discuss the first elements of our chapter's contribution, the relation between economic slack to inflation. So economists believe that there's kind of a latent unobserved level of potential output and that actual realized output evolves around that level. While it's thought to typically move very gradually, the level of potential output can also potentially be subject to very sharp short-term dynamics. Think about like 2022, potential output drops a lot and, you know, potentially recovers very fast back, but we're still in the recovery phase. The new Keynesian framework that's in use in many central banks around the globe relates the degree of slack, that is the resource underutilization vis-a-vis this level of potential output, to inflation. Broadly speaking, in the presence of anchored inflation expectations and in the absence of supply shocks, if unemployment is high and resource utilization is low, inflation is low. If unemployment is low and resource utilization is high, inflation is likely to be high. So we concern ourselves with the anchoring of inflation expectations in the next section and these sectoral supply shocks in the third section. So here we're really thinking about the classic relationship between slack and inflation and estimate a reduced form Phillips curve relationship. You see the results of the key estimate there on the right-hand side chart, split up for a full sample in blue. In red, it's kind of a sample pre-pandemic, and also split up between emerging economies and advanced economies. Roughly what you see, a 1 percentage point drop in unemployment leads to about a 20 basis point rise in inflation in advanced economies and about 2.5 times that in emerging economies. Now, these are typically reduced form relationships. We also do a structure estimation of that roughly confirms these figures. Now, what we can do with these figures is we can feed them into the estimates of what the IMF provides in terms of what is the natural rate of unemployment and what is our projected path of unemployment, and then back out from these numbers, what is the inflationary impetus coming from the demand side here, regardless of what happens to supply shocks and inflation. So we've done that here in the next chart on the left. And what you find is that the inflationary impulse is rather mild, right? So you see in 2021, about 23 basis points for the advanced economies, 14 basis points in 2022, and the effect dissipates down over the next 2 or 3 years. So really, the effect that we get from demand side push here is rather mild, although there's substantial heterogeneity. Like the US has far more accommodation than other countries. There's heterogeneity even within the advanced economies. But globally, this push is rather benign. There's a stronger impulse in emerging markets because the interaction between unemployment is higher. But we should also remember that part of the deviation from employment to the natural employment level is thinking about these short-term dynamics in potential output. And I would like to emphasize that again, we are very uncertain about the dynamics of short-term potential output. Okay, so the take-home message was, from the demand pull side, it's very mild. Now we need to think about kind of the intercept of the Phillips curve and think about how anchored are inflation expectations. And the good thing about that is that over the past 2 decades, we've made really big progress, especially in emerging markets, in anchoring inflation expectations. What you see on the left-hand chart is both for advanced economies and emerging economies, what is called an inflation of an index of inflation expectations. What do we observe? Well, inflation is far better anchored in the blue areas in the advanced economies than emerging economies, but emerging economies have managed to anchor inflation expectations a lot better. There's still substantial heterogeneity in both groups, as you can see by the interquartile ranges. And there are institutional features that are related to that. Central bank independence in the middle, for instance, the greater central bank independence is, the better is this inflation anchoring index. The same on the fiscal side, the default probability is really declining in this inflation index. So that's kind of the slow-moving short-term story coming into the crisis is actually a fairly good one. Emerging economies and advanced economies have done a really good job anchoring inflation expectations. Now we can think about what drives inflation expectations. Typically, we can run, for instance, regression on surprises of oil price shocks. In this instance, we look at the dynamic response of 5-year forward inflation expectations. We typically believe that these short-term shocks have played out after 5 years. So we think about what are inflations doing from 5 year for the 5 years following in the next 5 years. And we see the response to oil price shocks unconditionally on the top. So there's somewhat of a response, a 1% increase, surprise increase in oil prices, raises inflation expectations after 5 days by about a basis points on average. But what we also see that this relationship hasn't really changed during that pandemic. That is kind of the bottom one. The bottom one gives you the additional effect that you see during the pandemic. So we kind of reassure that at least through this mechanism, inflation expectations remain anchored. We could then do other things. We could think about how have past episodes of inflation accelerations in the past few decades looked like? What are kind of factors that are associated with them, and are those present at the moment? So we did that, and we also conducted case studies, and I highly recommend reading some of those in the wheel. But what we find is typically these inflation accelerations really come from large exchange rate depreciations and are preceded by an upsurge in the fiscal and current account deficits. So this is kind of the correlates of what you might potentially see across the globe if inflation is picking up in some economies. That's science policymakers need to potentially watch for. The final concern is really one of sectoral inflation dynamics. As I mentioned, this pandemic is special in the sense that we demand a lot more durable goods when we're all staying at home. There's a lot, even within durable goods, there's huge shifts. If you recall the big toilet paper episodes where toilet paper for home use is very differently produced than for office use and restaurant use. And if you flip from one to the other, these used to be very predictable supply chains. You see how this reconfiguration caused severe dislocations. So what you see here is plotted the sectoral price dispersion over time historically. So we put these historic, we put these price dispersions from these sectoral distortions into historical perspective. So, and from that you can generate an inflation dispersion index, and you can compare it to previous episodes. As you can see on the right-hand side, food, housing, and transport, the biggest items in the consumption baskets, are very volatile, and very volatile in this current juncture. But if you compare it, for instance, to the 2008 crisis, where housing was a sector that was idiosyncratically very affected, there is this volatility is not historically unprecedented. So that's the one thing, to keep a bit of a perspective of what is happening. What you can then do is you can use this index of inflation dispersion and feed it into a standard VAR model. And on top of that, what we do is we generate quantile VARs to give us a bit of an assessment of where the risks lie vis-a-vis our model outlook. So what we do is we take these sectoral dispersions, add it to a standard VAR, and give you estimates of what our model outlook is, including these sectoral dispersions. So that's what you're going to see on the next slide. So on the top left-hand side, you see the inflation outlook for advanced economies in terms of headline inflation. On the bottom slide, bottom right side, you see it for emerging and developing economies. And what you see is that inflation is expected to peak out at about 3.64% in the final months of this year, and then revert back by mid 2022 to about 2%, but you see there's wide ranges of outcomes here in advanced economies. It's somewhat higher in emerging economies, and this is our model outlook, but you see the risk distribution about that. Now, what you can do is you can then say, well, we live in very special times. Let's try and assume that there's further, let's draw from past distribution. Let's see what happens if there's further of these commodity price shocks to an extent that is unprecedented. So what would a 1% risk scenario look like? Because we want to inform policymakers about potential risks. Now, when we do that, we might get somewhat more extreme forecasts for inflation. So I show you that. So this is a scenario really where we have persistent commodity price shocks, and we also feed into the model these very persistent sectoral inflation dispersions that we've seen. So suppose supply chains remain, clogged for the next 12 months, what would headline inflation look like then? What you see here is you see somewhat higher inflation. it's a very extreme scenario, and it's going to get, the roller coaster is going to get even more extreme, because the next scenario I'm going to show you what happens if inflation expectations get unanchored, and then we'll see the outcomes there. What you do see is you see substantial peak of inflation is going to remain high, even in the advanced economies at 4.4%, and at 8.4% for the emerging markets. But they're going to revert back to the mean. So that's a very extreme risk scenario. The final risk scenario I'm going to take you through before concluding is what happens if for 12 months, inflation expectations are going to become unanchored. And that's really an extreme scenario, just as an illustrative case to make a case to policymakers how important the anchoring of inflation expectations is. So now let's assume that for 12 months, rather than being forward-looking, inflation expectations respond to incoming data and become adaptive. And what you see then is really on the top are the advanced economies, on the bottom, the emerging economies. What you see then is really this extreme scenario of potential double-digit inflation. And this is really there to serve a bit of a warning sign to say, look, it's really important that we watch that inflation expectations remain anchored. This is a very extreme scenario. So that's kind of the empirical exercises that we do here, and I highly recommend to read it up in the chapter. It's very interesting. So what are these main findings then, to just wrap up this presentation? There remains a significantly strong relationship between slack and inflation. The main challenge here is really getting a judge of where these short-term potential output dynamics are and what are good indicators of that. There's significant cross-country heterogeneity in the impasse of inflation due to slack. Inflation expectations have remained anchored. There's no evidence of recent exceptional unanchoring of inflation expectations. There is limited risk of de-anchoring going forward, despite this temporary rise in inflation expectations in EMs. Sectoral price dynamics suggest moderate risk thus far, and inflation forecasts show a sharp rise in inflation in the short term. We all know that, but policymakers really have to look through that. And this is where we really get to these policy implications. What is really important is that policymakers are aware that they walk this tightrope between acting patiently and supporting the economy, but at the same time, they need to be prepared to act quickly if inflation expectations show signs of de-anchoring. What we need is clear state contingent forward guidance and communication, and we do need strong fiscal credibility, which is important for inflation anchoring. And with that, I would say I leave you.
Great, thanks very much. I want to turn it over now to my colleague, Tara Sinclair from George Washington University for comments. And before I do, I just want to remind everyone that you can put any questions you have in the Q&A, and then I'll be able to bring those over to the presenters and discussants during Q&A time. Sarah, go ahead.
Great, thank you, Jay, and thank you, Christopher. This is a fascinating chapter, and I'm really excited to be able to discuss it. And especially with the theme of Halloween coming along, thinking about inflation scares. And of course, we've had a lot of discussion in various economic spaces about the term transitory and talking about team transitory versus team persistent. So I'm taking a slight variation on that and talking about team brief fright or team long nightmare. So let me just dig in here. Christopher did a great job describing the particular focus of this chapter. I want to highlight a couple of things. The first is that, at least as of the writing of this chapter, the focus was really that inflation is expected to be back to pre-pandemic levels by mid-2022, although with an acknowledgement that risks are tilted to the upside. And that's one thing I want to talk about as I go through the discussion. The other thing is the three drivers that Christopher highlighted, thinking about the role of demand, of commodity prices, and of shortages and supply chain disruptions. Kind of what I want to build on in my discussion here is maybe some of the other aspects that we want to think about as well when we're thinking about inflation. But first, I'd like to turn to the discussion of sectoral shocks, because I think this is really a fascinating part of this chapter. And really, to be able to find something that was worse in the Great Recession as compared to today, I think is informative. And so one thing I wanted to highlight, and Christopher already did a great job describing what they were measuring, but I want to point out that the chapter ends with a sample through June of 2021. And so one of my questions I'd like to throw out is, are y'all updating this index, and how has it evolved through the summer, and in particular through the Delta surge? Because it seems like there's a lot more discussion about sectoral inflation dispersion since the June 2021 end date here. And I'd also like to highlight the scarier view, and this is looking just at US data, but this is from the San Francisco Fed, and this is their T-diffusion indices of price increases. And so this is the share of items and expenditures that are 2 standard deviations above the average 12-month inflation rate over the past 5 years. And this has really skyrocketed to near 50%, and we'll get an update from the new data today and the next couple of days from them. But it really looks like, in terms of the diffusion of price increases, we're really seeing it spread, at least in the US, more across the board than initially. Initially, we all had our different preferred measures that would throw out a particular set of pandemic exposed sectors or goods or prices of very, many different measures were proposed. And initially, back in the summer, there were a lot of those sorts of studies that suggested that it seemed to be relatively localized. But now, in recent months, it really seems like things have shifted, and the concerns about rapid price growth is really spread across a larger range of sectors. Similarly, so still looking at US forecasts, we really see that forecasters are predicting both that the supply chain problems are going to last longer than initially thought, and also that we're seeing this constant ratcheting up of both how high inflation might go, and in particular, how long it might stay above the kind of target range of the Fed, although this is for CPI, not for PCE. And I do wonder, how much, when we're looking at what's driving prices in the, are there certain US specific things that, particularly around policy, that might make us exceptional, and so that we might be seeing inflation spread across the world, but for different reasons, or are we all under the same stars? But also, I still think it's really interesting to keep in mind that when we think about pandemics historically, there was this really great research out of the Netherlands Central Bank that really suggested that historically pandemics have been followed by years of disinflation or deflation, and yet it's really possible, due to the strong policy responses to this pandemic, that we might get something different this time. And so I think that's something really interesting to think about, that do we still have some of those pandemic pressures down on prices, or did we completely knock those out with the extraordinary policy responses? And how persistent might each of these factors be? I also want to highlight, because Christoffer talked a fair bit, and the chapter talks a fair bit about inflation expectations, this really provocative paper that recently came from Jeremy Rudd at the Federal Reserve Board, really questioning the role and importance of inflation expectations in our macroeconomic models and in our forecasts of future inflation. And so, I do think that this is really causing a rethink and a re-exploration amongst academic researchers on how much emphasis should we put on expectations for forecasts. And I think that that's something to keep in mind, that whether the inflation expectations are anchored or are not anchored, might either one of those give us the right forecasts for the future evolution of inflation. Also, when we're thinking about the wage price cycle that some people are concerned about, I've really been thinking a lot about, people have called it the Great Resignation, but I like this concept of the Great Renegotiation when we're thinking about the role of wages in the labor market. And so particularly here in the US, I really like this quote from Betsy Stevenson, talking about like the whole country is in some kind of union renegotiation right now, and that we really are seeing, potentially a strong shift, obviously in part in response to the pandemic, but we might also just be, really coordinating at this time to respond to the longer term previous declines in terms of wages relative to productivity, and also the decline in the labor share of income. So really the question here in this renegotiation is it a one-time level shift, or are we really going to see a different pattern in wage growth going forward, and how much of that is going to translate into prices versus reallocation of the shares of income? And of course, there's also this debate around thinking about this era of abundant, cheap labor that Ryan Avent has talked about. Is that something that is over now, and and this potentially at the global level, and both in terms of being able to have cheap labor overseas as well as cheap labor domestically, or could we actually have this whiplash where we get more automation, and that automation there isn't enough demand that comes in and supports all of that expansion and capacity, and we end up back in a weaker economic state in terms of labor market positioning. So kind of to wrap up, I could definitely talk about inflation all day here, but I was thinking the same image that Christoffer talked about in terms of thinking about the tightrope that policymakers are walking, because there's clearly reasons to lean towards either team brief fright or team long nightmare, and I see the short-term concerns or the expectations that inflation might be more of a short-term phenomenon, really coming from a lot of evidence that the demand pressures might be easing, but there's also a lot of evidence that long-term supply challenges may continue. And one that I'll just highlight here for time is this role of demographics, because I think that's one area that we're continuing to look at for thinking about long-term inflation patterns. Is how much does the baby boom generation, will their consumption slow in retirement, and that put a drag on demand, or will their drag on supply really make a difference here in terms of lower labor supply and that higher dependency ratio? And that bell says that I should switch to the thank you slide. So thanks very much.
Great, thanks very much, Sarah. And it's very nice when you have a bell and I don't have to do the bell. That's great. So I want to actually just to start the quick kind of conversation here by giving Christoffer an opportunity to respond to a couple of questions Tara laid out. In particular, if you do know how kind of the dispersion has looked since June, or for that matter, if thinking about it, at least within the US, it looks like maybe it is spreading out a bit more recently. That was one. The other one, because it struck me also during your presentation, there was a lot of weight on expectations and the importance of expectations. And I think that's true in much of the economics literature. And I just didn't know if you had thoughts, or if your team had thoughts about people like Jeremy Rudd raising questions of, how much do we really want to put on expectations, and have we kind of comforted ourselves too much with that?
Yeah, okay, so you had 7 very nice points, and yeah, Jay pointed me to 2 of them. I have responses to all of them, but let's do that 11:30 when we do our after chat. So on the dispersion, there's Americans always have these beautiful data sets. I've worked 10 years for the Fed, and it's wonderful, timely. So this is an advanced economies data set where, so first of all, there's kind of this excuse of a production timeline of the fund. The other thing is it's far more slow moving on the international data front. That's blunt and plain. Like for the US, yeah, thanks for pointing that. In fact, I took a screenshot so I could look that up. Yeah, so it could be, yeah. Look, we talk to Maersk on container shipping. I talk to people in bulk shipping. It's very hard even for these global shipping companies to tell you when these things are going to be unclogged. So in some sense, what you feed into any of these models, how long these supply chain disruptions are going to, I'm not saying it's anyone's guess, but there's a large degree of uncertainty and the shock is unique. So it's not, we'll all be smarter economists 3,000 years down the road after 25 more pandemics. But right now, that's interesting. On expectations, I mean, I guess Jeremy Rudd is a bit out of the mainstream. I think it's very provocative. I like that. I do think, though, and this is my personal views, not the fund views, I think it always takes a model to beat a model. And I know famous people have said that. I think it's important to think out of the box, but I do think we have frameworks that people have thought a long time about. And before one read it, I mean, we know all of that. There's great work by Grotnichenko, by Oli Kobion, and others about expectation formation. I just err on the side of what we've been discussing for the last 20 years. Because if give me a model of expectation formation process, and we can run a horse race between these models. But these are my views, not the fund's views. So, and I'm looking, there's a lot of stuff that I could pick up on what you said. I mean, it's brilliant. I think there should be something like a P-star. I think there are low frequency supply shocks. Think about reversal of China, urban rural migration. I mean, all of that, it could be even an inflection point that is related to the wage bargaining within the US. I mean, all great topics. I'm really looking forward to having more of a chat later about those. Yeah.
Great. I had one other question that came to me was when I was looking at your forecasts of the inflation rate coming down, in particular in the advanced economies, but really in everywhere, that the thought is we've got this rise and then they're coming down. If I caught it quick enough, it looked like the US one was coming down on John's slides, I think it was, where the US was coming down to like the 2.5% to 3% range. And it occurred to me, I wondered if you had looked how, yes, they're coming down, but are they coming down to target? Or how quickly are they coming down to target? And what does that mean? Again, going back to the expectations, right? US inflation could certainly come down and still land much higher than people were originally expecting, or higher than target. And would that change the expectations? Is that something that in the kind of, because I think you could view those slides optimistically of, hey, look, they're all coming back down, or kind of to Tara's, team long nightmare, they're not coming back down far enough.
Well, there could also be maybe more benevolent nightmare. I mean, there's been two things going on from the policy side in the US, right? I mean, we have the framework, we were worried about disinflationary spirals, right? That's why we changed the framework. Unfortunately, we changed the framework at a time when this comes in. People have talked about like opportunistic disinflation. Maybe we can talk about opportunistic inflation now and just keep going with it. And who knows where we actually, I mean, in some sense, we wanted to bring inflation expectations up by 40, 60 basis points so that we get an unconditional 2% rather than this declining spiral. It's hard. It's a bit of an unfortunate timing of the framework change, but, if we revert back to a condition on being in an expansion 2.2, I don't think policymakers would be utterly worried. But again, I'm neither speaking for the Fed nor the IMF, so.
And then I did just want to, since I directed you to two of Tara's points, I didn't know if there was anything else you wanted to reply to now before we jump to the next section.
Well, I mean, I love these infinite stories of like 700 years of history of Dutch, but I would say if you look at US history, we've only been worried about inflation for 1 decade out of, say, 200 decades, right? I mean, the main worry in economic history was disinflation, deflation. Whole political debates emerged about that. So we have to think, like, when we do these pandemics, we also have to think about we now can do fiscal and monetary policy to an extent that is unthinkable in the 19th century. So it's always a bit, I love economic history. I'm a great fan. I'm just wondering, sometimes we push things a little too far. So, but look, all these points, I love them. I took notes of all 7 of them, and I'm really looking forward to chatting more. So.
Actually, can I jump in with one more question just based on what you just said? I'm just curious. So, because it sounds like you're still really strongly team, brief rate. Is that a correct interpretation of your personal views?
Yeah, I mean, I don't think yes.
Okay, great. I think we may come back to some of these topics at the end. I think at this point we wanted to to jump back over to the third chapter here, chapter on research and innovation, fighting the pandemic and boosting long-term growth. And we'll hear from Jean-Marc Natal, who is a Deputy Division Chief at the World Economic Studies Division of the IMF's Research Department. And then the discussant will be Ben Jones.
Thank you very much. Sorry, do you hear me?
Yes.
Yes. Okay. Thank you. Thank you very much. Shifting gear here. Thank you very much for the invitation. Thanks to Kyle and Jay. It's a great opportunity for us to present our work. The chapter, which is joint work with my colleagues Philip Barrett, Niels Jacob Hansen, Dia Nureldin, Evgenia Pukacheva, and Max Rodzicki. And finally, last but not least, Xiaoyu Sun, who provided fantastic help on this chapter. Okay, so the chapter is about the importance of research for innovation and growth. And let me start maybe with some background. The idea for the chapter came as the first mRNA vaccine were being distributed. Well, of course, the vaccine development saga is fascinating in its own right. For us, it was a perfect illustration of three important points that inspired the work. First, that innovation can boost economic activity tremendously. Beyond saving lives, the vaccine allowed a much earlier reopening of many economies, with, of course, very large economic gains. Second point is that while applied research, which is the largest part of R&D, is useful to bring innovation to market, basic research or fundamental research is actually necessary for breakthrough innovations. And the third point is that there are long and variable lags between basic research and marketable innovation. And the chart that we put here on the right-hand side, which is based on a new database, which is called Reliance on Science, which forms the basis of our empirical analysis, I think clearly illustrates these points. What we see is that the three generations of patents that led to the Moderna vaccine relied directly and indirectly on scientific research that goes back to at least the 60s. This, of course, suggests that today's basic research is likely to drive future technology development in the same unpredictable way. Okay. So, given that we know all this, or at least we think we know all this, it might be surprising that productivity growth has been declining in advanced economies, despite a steady rise in expenditure in R&D. That's the left-hand chart, when you see the productivity growth declining since the 80s. One possible explanation, which is also a central theme of the chapter, is that it's not so much the total amount of expenditure in R&D that matters, but its composition between basic and applied. And indeed, when you look at the middle and right panels, we can see that related spending in basic research has declined at the exact time when basic research was becoming increasingly important for innovation. And on the right-hand side, you can see that patent citation of scientific article, which is our proxy for the diffusion of basic science, is above patent citation of other patents, which is our proxy for the diffusion of applied research. And this since the early 80s. So the blue line is above the red line. Now, one of the key findings of the chapter that could help rationalize the productivity puzzle that we just showed is that basic research diffused farther and for a longer time than applied research. And on the left panel, which is based on a gravity equation, which is described in the paper at more length, so the left panel shows that various geographical barriers like language or borders do not affect the diffusion of basic science as much as the diffusion of applied knowledge. And you see the red line above the blue line for most of the chart. And at the same time, basic research also has a longer shelf life than applied research. On the right-hand side, you see that scientific articles are cited for a longer time than other patents, with the mode of the distribution at about 8 years instead of 3 for applied knowledge. Now to the next slide, or empirical analysis. So to better understand quantitatively the relative importance of basic and applied research for productivity, the first step is to understand the relationship between research and innovation, which is measured here as patent flows. To do that, we estimate what we call an ID's production function, which is based on a panel of 38 advanced economies and emerging markets over 37 years from 1980 to 2017. And the left chart shows that basic research is actually a strong driver of innovation. On the right-hand side, you see that the impact of foreign basic research on innovation is particularly strong, pointing to large international spillovers. And this is in line with the status fact that we just presented on the last slide. And it's also further evidence, in our view, that the type of research that you do matter for innovation. And an important point, I think, which you see on the right-hand side, is that access to foreign research has a large effect on innovation in emerging markets, and a larger than in advanced economy. I think that's a point that we will turn to again later on. So now that we have established that basic research drives innovation, we can now turn to the second leg of the relationship, which also finds strong evidence that innovation drives productivity, and especially for countries with relatively educated population and deeper financial markets. And that's on the left panel. Now the right-hand side, the right panel on the right-hand side, it puts it all together. So the two legs of the relationship. And doing this, we get on average that a 10% increase in investment in basic research would increase own productivity by 0.3% permanently, and the effect would be double for a similar increase in foreign basic research, which is the right-hand side panel, and again underlining the importance of spillovers. If you turn to the estimation of the ID's production function that we presented before, you remember that the effect would be even bigger for emerging markets. Now, turning to policy analysis, we analyze in this paper also alternative research policies by estimating a general equilibrium model, which was developed by Akshigit and co-authors, and we estimated for three countries: France, the UK, and the US. Briefly, because I don't have time to go in all details, but one of the main features of the model is that firms can invest in basic and applied research. But because basic research diffuse strongly, firms cannot capture the benefit of investment in basic research, which will then be too low in equilibrium. In the model, policy can correct for this negative externality by subsidizing private research or investing in public research, such as university or labs. So turning to the result, running optimal policy, we run various policy experiments that I won't have time to describe here, but I invite you to look in the paper for that. I'm happy, of course, to discuss that further later on. But in a nutshell, we can say that optimal policy implies more funding for basic research in the model, and this for the three countries. And all combination of optimal subsidies and public expenditure leads to higher growth. And the more targeted the subsidy, the more cost-effective and welfare improving the policy will be, obviously. Now, because it's sometimes difficult to distinguish between basic and applied research, one feasible optimal policy, which is shown as the red rectangle on the chart, would double current subsidy for research and increase public expenditure on basic research by about a third. Such policy would increase annual productivity growth by about 0.2% a year, which is not trivial, knowing that certain estimate of TFP growth for the US put it as low as 0.5% during the last decade. And such policy, according to our calculation, would start paying for itself within a decade, which is an important point when you think about investing in research. Let me now wrap up and with our takeaways. The first one is that we think that the chapter shows that basic research diffuses more and for a longer time than applied research, and is also a key driver of productivity growth, both in AEs and advanced economies, and emerging markets. In emerging markets, the adoption of foreign knowledge plays even a larger role for innovation than in advanced economies, and it also plays a larger role than homegrown research. And finally, institutions matter. Better education and deeper financial markets are key to facilitate technology adoption. And not surprisingly, then the main policy implication of all this is that basic science is underfunded. Where possible, subsidy for basic science should be increased and better targeted. Collaboration between public and private researchers should be improved. And to facilitate cross-border technology adoption in emerging markets, it's crucial to ensure a free flow of ideas and strong international collaboration. So I stop here. I'm looking forward to the discussion and question. Thank you.
Great, thanks very much. I'd like to turn it over now to Ben Jones, who I neglected to give his title, in part because it's a very long title and it's intimidating. I believe Ben is the Gordon and Laura Gunn Family Professor of Entrepreneurship, Professor of Strategy, and the Faculty Director of the Kellogg Innovation and Entrepreneurship Initiative at the Kellogg School of Management at Northwestern University. More importantly, Ben is a real expert on economic growth and innovation. I had the opportunity to learn a great deal from Ben on those topics when we worked together for a year in government service, and I'm really looking forward to learning more from Ben now. So Ben, the floor is yours.
Thank you, Jay, and nice to be with everyone today and have a chance to discuss this important chapter. So let me just jump in, given the limited time. I think there's a lot of motivations here for why we and the IMF can be thinking about R&D. The productivity slowdown, how do we reverse that? That is one motive, as Jean-Marc engaged. More generally, if we just think of R&D as a key driver, as we do in basically all modern models of economic growth, a key driver of rising standards of living, as well as things we don't necessarily account for in statistics of GDP statistics, like improving health, which might be as or more important. The question then always becomes how much R&D should we be doing, and how could we do whatever we're doing better? And I think there's a whole number of other motives which come up in this chapter to some extent. One is how do we solve for known problems like pandemics, and this chapter does a nice job of showing how the mRNA vaccines that have been so important to trying to overcome the pandemic depend so deeply on recent science. Climate change, of course, and any number of other kind of known problems and challenges that threaten human welfare and growth around the world. Another type of question is how do we manage debt sustainability? In a world, it's a very IMF-like question of in a world with rising debt to GDP ratios, it's always easier to raise your GDP than pay off your debt. And R&D can be essential to doing that, both in the R&D producing countries, but also through spillovers more globally. Another interesting feature in the chapter I was discussing is the potential implications of China and US decoupling. And do we think about that simply in kind of a static trade-oriented way, or should we think about that much more in a dynamic way based on the ability to share ideas across borders? With the idea that anything that's affecting the growth rate of countries is of course going to dominate the welfare consequences compared to sort of static models of allocation or misallocation, certainly over the longer run. So one motive, this is just a related graph. This is the U.S. We can see that the total R&D as a share of GDP, that's the blue line at the top. That's been actually going up, but generally it's around 2.5 to 3% of GDP historically in the U.S. But you can see that the green line, which is government funded and where a lot of the money comes for basic research and science, has been declining. It's actually half its rate now as what it was in the 1980s. And government-funded research as a share of GDP now in the United States is actually nearing its lowest level in the last 70 years. So, the paper is sort of making an argument that the decline in or the lack of basic research may be part of the explanation for the productivity slowdown, which I think is a very interesting thesis, though of course hard to pin down. So that the chapter goes on and looks at several important analyses. I think two of the central ones are these country level regressions, which were shown here that I just emphasized in Jean-Marc's presentation, showing how foreign basic research and own basic research can predict increased productivity, and also using more within country firm-based analyses based on basic versus applied research expenditure and resulting patents behavior, building on this paper by Ufuk and colleagues. You can come to an estimate that from microdata that perhaps you could increase growth by 0.2% through various fairly straightforward policy fixes. So again, there's sort of a lot here on the table, policy-wise, a lot of opportunity. So let me just give some comments, stepping back. So first of all, very nice for me to see the IMF engaging R&D. I think of the IMF as more about stability, but of course, in promoting long-run growth, this really is a central pillar. And so it's just great to see that attention. I think in the question of, what are the returns to basic research, or we could think about as more scientific oriented research. I know this is just a fundamentally hard question. I think empirically, if you think just yourself, introspect on what you think the return to the internet is, or the Human Genome Project, I think you will quickly decide that that's a very hard question to answer, because it has so many different and complicated effects and spillovers. It's very hard to pin down what its return to investment was. And they're still, of course, playing out over time. So, I think the empirical ideas in this chapter are really quite useful. There's sort of these cross-country regressions, thinking about links between various kinds of research investment and productivity growth ultimately. And there's also more micro and model-based estimates from patent data in a few wealthy countries. So I think these are quite interesting and informative exercises. Nonetheless, I think it is also hard to produce kind of a causal marginal return to basic research, because the spillovers are so complicated. And of course, the spillovers between applied research and basic research are going in both directions. And it's a very mixed, very complex landscape. It's very hard to pin down. So just I think, and I don't think the literature has really pinned it down. So I think this chapter is making a very useful set of analyses to kind of push things forward. At the same time, there are other kinds of analyses. There's, of course, stories. And I think if you just look at the birth of new industries, whether it's biotechnology or mobile internet, it is very clear that this entire industries hinge on very specific scientific insights from before that were funded through or not funded by corporations. Let's put it that way, not funded in the private sector. So, I think you can do the storytelling version, which I think can be quite powerful and salient. You can also look at descriptive high-scale findings about how science, is built on generally in, say, all patents or in marketplace innovation. And then there are some limited natural experiments that sort of look at, if money rains down on a science agency like the National Institutes of Health in the United States, and you can make an argument that it's kind of deployed in a kind of quasi-random way, you can then follow that through to look at, say, future drug development and show, in fact, that there are really salient causal chains and then large social returns to those activities. One example using sort of descriptive data, this comes from Martin Botzlinger et al. It's a recent working paper. It builds on a measure that I developed with Mohammed Ahmedpour, a former postdoc who worked with me. You basically take every patent and you sort of ask how far it is from science. Does it cite science directly, or does it cite a patent that cites science directly? You build a network and you have a distance from science, which is here on the horizontal axis, and then you connect it to the market value of the patent. And basically you see that patents, and this is all US patents in this example, patents that build on science are more than twice as valuable on average than patents that are unconnected or very distant from science. So there's a very strong sort of micro data link between basic research and more marketplace, more valuable marketplace innovation, at least descriptively. So I think that you can marshal like a whole bunch of evidence in this direction, even though I think at the end of the day saying, R&D on basic research is especially valuable versus applied research, I think that's more of an open question. What is clear is that investing more in R&D in general seems very well motivated and with very high social returns. There's just enormous literatures like, Alston et al. Reviewing hundreds of studies in agricultural R&D, or Hall et al. Looking at those, but also hundreds of, many studies, and not hundreds, tens of studies, say, in industrial R&D. Nick Bloom and co-authors have an important paper from 2013. I have a recent paper with Larry Summers where we try to do an aggregate index version using macro outcomes, and we seem to find incredibly high social returns to small investments in R&D. So, for example, our conservative estimates in our paper suggest that for every $1 you put into R&D, society is getting at least $5 back, and maybe much higher rather. Social rates of return on all these kinds of studies tend to be extremely high, on the order of 50% is a common number, which is just an incredible return. And it really raises the question of why we in any government, certainly in an advanced economy, isn't investing more. We invest a really small share of our resources, 2.5%, 3% would be high, on R&D. And why are we doing so little, given how important it is to growth and health and standards of living, et cetera? So sort of in that big picture and a lot of that research, and there's a big literature here, I think you just can't come away from this without saying there's not enormously high social returns to R&D. What is a little trickier is, well, but which lever should we do more with? R&D tax credits? Should we do more with sort of small business and new venture assistance? Should we do more with basic research? And if so, in what way? And there's lots of ways to do basic research. How basic? How applied? Through national labs, universities, these kinds of questions. There are many, many levers. It's a big ecosystem of science and innovation. And I think, we pinpointing which levers are sort of optimal is just beyond the literature as it is. It's a very hard question. There are nice natural experiments of certain policies, like, for example, R&D tax credits look very good in the modern literature in terms of the return. That's to commercial R&D from private sector players. Some narrower experiments, natural experiments in science suggest also very high returns in that regard. But what I want to leave you with, the final comment, which is, again, really great to see the IMF engaging R&D and trying to also make this additional insights about basic research and sort of science versus more applied R&D, all very useful. But I think we should, as in policy, don't want to let the perfect be the enemy of the good in this context. It just seems very unlikely, based on all the evidence in the literature, that we will not reap high social returns from more investment in science or in other forms of R&D. So if a policymaker said to me, we want to invest more in science, like in the Endless Frontier Act before in the US right now, or they say, I want to extend the R&D tax credit, I'm going to say, go for it. Either way is good. That's going to pay for itself, and has a lot of great prospects. So while I'm very sympathetic to the basic science focus here, and I do think there's a lot of evidence consistent with that, that's becoming a problem, and it really does unleash new industries. So I think we could do a lot more with science and really just catch up to where, say, the US used to be in that regard would be a big thing to do. But ultimately, we want to do more R&D in general. And so I think anything rowing in these directions is really extremely valuable. So thank you very much. I think that was my allotted time, and great to be with you.
Great, thanks very much, Ben. So I want to have a little conversation here. At first, I maybe give Jean-Marc an opportunity. If there's anything in particular you wanted to pick up on out of Ben's comments, I want to make sure you have an opportunity to do that before I start peppering you both with questions.
Please, Pepper. Yeah, no. Let me just first thank Ben for the very useful comment. I think this is well taken. As you pointed out, it's a very large topic. I don't think we explore all of it by far in this chapter. It's an attempt at looking at it from our perspective and looking at cross-country data. I think your main point regarding the methodology is on identification of the causal link, and again, it's also a point well taken. I think what we do here is trying to push robustness as much as we can, using the reliance on science data, and approach the topic from different angles, from storytelling with the Moderna case, and also using a general equilibrium model with microfoundation and microdata to try to get more to the causal link using the theoretical apparatus. But that being said, I mean, your general conclusion that more investment in R&D is something that we should favor is shared, of course. What we wanted to do here is really highlight the fact that, as you put on your graph, I mean, firms continue to do R&D, and admittedly not enough. But what is really missing is basic research, which is kind of disappearing slowly. Of course, firms don't do it because don't do as much as they should, because it's not as rewarding in terms of return. But when the government stops doing it, we could see, and it would take time, impact down the road in terms of new waves of innovation that will not take place. And this is why we wanted to focus on this particular point, which to us was the major distortion that we could see. But thanks again. I'll be really happy to talk later bilaterally.
I want to point to one question Ben had, and actually, Ben, I'd be curious what you have to say about it also. But the returns seem very large, right? Like they seem really, really big, and especially even when you start saying things like, this will pay off in 10 years, right? Then you start saying, well, even if you tell me my concern is fitting things in a 10-year budget window or things like that, it looks free to governments to do this, and then just has all these huge benefits to society beyond that. And so I guess the question I'm curious from either one of you, so then why aren't we doing more, right? Like we have gotten richer as societies, and yet we're doing less basic science research than we used to. And that feels like a very odd choice. And so why?
Oh, well, I think that is the great next question. I think you're hitting the nail on the head there. And I don't think the research community has an answer to that. But let's just talking about some of the forces at work. Let's just be clear that science is esoteric and complicated, and the average citizen's capacity to understand its importance is low. People have all sorts of mythical ideas about what science is. The ivory tower, this idea that scientists do things that are just, kind of like strange animals in a national park off in the wilderness. They seem like kind of a different species, and how is that relevant to me? I think there's just a lack of understanding around science. The place you see political will come in science is often when there's a sense of crisis. So if you think about World War II, there was an enormous, very fast, very successful effort under Vannevar Bush, FDR kind of deputized to sort of run the apparatus, and it's famous, of course, for the Manhattan Project in the U.S., but it should be famous equally for the first mass production of penicillin, solving lots of problems in health, radar, sonar, et cetera, and things that I think, incredibly, ultimately led to winning the war was the science investment. You go to the Sputnik moment, right? And suddenly we have the Apollo program, a huge increase, right, in the United States. Then you have today a sort of a fear of China, for example, or the pandemic, when we see Operation Warp Speed. So I think that in some sense, there's sort of a vague public appreciation of it, but it's sort of not, it's not very salient to people, and they sort of lose sight of it in between crises. And I'll say the other thing is, think about political discourse around this. Think of like the Solyndra case in the United States. And I apologize in the IMF context for keep picking US examples, but this idea that the government is bad at investment. There's a whole bunch of free market ideology that's of course mixed into policy, and can we trust the government to do these things? And and then of course the other thing about innovation, like what is R&D, especially basic science, but even corporate R&D, it's a stumble in the dark. You fail all the time. Pharmaceutical firms, all the major ones, 1 out of 10 times once they go to human trials does it actually work out. Venture capital investments, the investors who invest in small businesses in America thinking they're going to make a lot of money, they will tell you right off that they fail the vast majority of the time. And so that can also lead to a sense that the investments don't work, right? That we're just failing all the time. And it's these sort of strange people failing all the time, and aren't markets great? And I think in that sort of mix of cultural ideas, people think that maybe investing more money in this is a waste. But when you look at things on net, you find there's this incredible return. So I guess the next question is, how do we communicate that in a way to policymakers and the broader public to increase appreciation and therefore unlock the gates to something that's in the interest of so many people?
Yeah, to add to this, I think this is one of the goals of the chapter, trying to communicate that. And as you said, the major difficulties, what I call the long and variable lags. You have no clue when a certain project will or if will pay out. And especially in basic research, which has much longer shelf life, and the interactions are much more difficult to appreciate. So I guess, you know, without going into the political economy of how you favor this type of investment, I think there is clearly a difficulty for government facing, you know, what is perceived as urgent in a politician lifetime constraints to be able to convince simply their constituent to invest sums for very unlikely, very difficult to capture project and with uncertain results. The thing is that when results are there, the effect is huge, and you just saw it right now with the vaccine. So, you know, we just try to communicate this more and more.
I had one question, which is, you know, Jean-Marc pointed out for the audience that, for anyone who doesn't know, kind of one of the most basic findings in this literature is that an individual firm won't recoup all the benefits from any R&D investment it does, and therefore R&D is underinvested in. But your research also points to the same thing at the country level, right? Like, you're showing massive gains from foreign research. And so I'm wondering, in some sense, does this point to kind of a global cooperation failure and very much an IMF challenge, which is countries underinvest in basic research because they don't recoup enough of the gains? Now, the research you're both citing suggests they recoup so much they should do it anyway. But is it also a question that maybe some sort of global cooperation problem to kind of cross-subsidize basic research because we all benefit from it?
Yes, I mean, it's clearly a global public good, but you're right, you can do it purely on your own polity's interest because it's in your own interests. But if you look, so Larry and I in this recent paper, we look at the social returns in the US, and then we say, what about the G7? What about the OECD? And as you expand out, the social returns go up because, you know, you're getting all these benefits from cross-country spillovers. So I think that's an interesting question for the IMF, is the question for the OECD and other international bodies.
Yeah, fully agree, and I think the effect, as we show, are particularly important for emerging markets, as most of the basic research takes place for now in advanced economies. But as you pointed out, I mean, it's a win-win situation. You know, improve your economy, and at the same time, the spillovers are even bigger to the rest of the world. So yeah, we agree.
So we got one question that came through I wanted to flag, is asking kind of what sort of policies related to technology transfer could encourage more basic and applied research funding? So is the problem that we're not able to kind of transfer technology, whether it's cross-country or into industry, or is the problem just we're not doing enough of the basic research?
Okay, so we might have different views on that, Ben and I, but I think generally we don't do enough of both. But in our view, the biggest leverage, and given the recent trends, would be to recommit to basic research with, you know, uncertain returns in the short term, but larger payoff in the long run. But it's a long pipeline. You have to start. So that's where I would put the emphasis.
Yeah, I would just add, I think there's positive returns to both. If I had to put my thumb on it, I would say it's much more on the scale of basic research that we do. And the reason I would say that is, so first of all, when a patent cites a paper, like you bridge from science to the marketplace, if you will, those patents that cite papers almost always come from private companies, and the papers they cite actually almost always come from universities and some national labs. It's not really like in-house basic research at GE that leads to the patent. It's much more this transfer. And then you might, so that is a very important question, that technology transfer from one set of institutions to another really matters. But if you look at the data, you see an enormous amount of transfer. It's not like there's all this bottled up work, and that's really important in the university setting that the private sector is just like ignoring. So I think and there's big literature on this, and I don't mean to downplay it, because I think there are lots of ways you could improve it, but I think those are sort of probably more marginal fixes, tactical fixes, in terms of some of the incentives on both sides of that. But if you think about the overall thing that's holding us back, I think we're just not doing anywhere near as much basic research on as many topics that we know about. We have lots of topics we could be doing basic research on that we're not. It's not like we don't know what to do. So I think it's really a scale problem, as Jean-Marc has emphasized in this chapter.
Great. Thank you both. We've just hit our time limit, and so we'll probably stop here. It's a fascinating topic, and I, as with Ben, I'm really pleased to see the IMF dig into it, because I agree it's such an important thing to long-run growth, which is obviously something that IMF cares a lot about, but also just to human welfare more broadly. When you're talking about how you think about the returns to basic science, I just kept sitting there looking at your picture of the Moderna patents history and thinking, how would we calculate the returns to some of those early patents that were crucial there? Not just to GDP, but to human welfare more broadly. And so it's a huge topic and an important one. And so thrilled to have it on the agenda today. So with that, I just want to wrap up, thank the audience, very much thank our discussants for their time digging into these chapters. And once again, thank the IMF for partnering with us on this endeavor of bringing the research they're doing in the World Economic Outlook into a broader debate and broader conversation. So thanks everyone for joining us, and thanks again to all the panelists.